You bought the house. You made every payment. You maintained the property. You did everything right. And then one morning you walk to that mailbox, and inside it is a letter from your county assessor's office. Your property tax assessment has increased by 42% in a single year, on a home whose mortgage you have been faithfully paying for 11 years. You are now facing an additional $4,000, $6,000, maybe $8,000 in annual property tax liability that was not in your budget 6 months ago, and if you do not pay it, the county places a tax lien on your property. Let that sink in. A government entity can place a legal claim against the home you have been paying a mortgage on for over a decade because of a number that a government assessor calculated using a methodology you were never shown, never explained, and never given a meaningful opportunity to challenge. And here is what makes this even more outrageous. In most counties across the United States, the majority of property assessments contain errors, valuation errors, classification errors, exemption errors, errors that cost American homeowners billions of dollars in overpaid property taxes every single year. Errors that most homeowners never discover because nobody told them how the system actually works. I am Engineer Vance, licensed forensic structural engineer. I spend my career evaluating properties, and I can tell you from direct professional experience that the intersection of property assessment methodology and structural reality is one of the most consequential and least understood financial relationships in American homeownership. Today, I am going to walk you through everything you need to know about property taxes, how they are calculated, where the system fails homeowners, and exactly what you can do to protect yourself from overpaying a single dollar more than you legally owe. Let us start at the foundation, because most American homeowners have a dangerously incomplete understanding of how their property tax bill is actually generated. Property taxes in the United States are administered at the local level by counties, municipalities, and special taxing districts, which means the rules, the rates, and the appeal processes vary significantly from state to state and even county to county within the same state. But the fundamental calculation structure is consistent across the country, and understanding it is the first step to protecting yourself. Your property tax bill is the product of two variables. The first is your assessed value, the dollar value that your county assessor assigns to your property for taxation purposes. The second is the mill rate, also called the tax rate or levy rate, which is set annually by your local taxing jurisdictions, your county, your school district, your municipality, and any special districts like fire, water, or transit that have taxing authority over your property. 1 mil equals $1 of tax per $1,000 of assessed value. So if your assessed value is $300,000 and your combined mill rate is 20 mils, your annual property tax bill is $6,000. That is a straightforward calculation. What is not straightforward is how that assessed value is generated, and that is where the system fails American homeowners at a scale that is almost impossible to overstate. Your assessed value is not the same as your market value, and that difference is where billions of dollars in property tax errors originate every single year. Most states apply an assessment ratio, a percentage of market value at which properties are assessed for tax purposes. In California, assessed value is based on the purchase price, with limited annual increases under Proposition 13. In Texas, assessed value is supposed to represent 100% of market value. In New York, residential properties may be assessed at a fraction of market value, depending on the jurisdiction. In Illinois, the assessment ratio varies by property classification. Understanding your specific state's assessment methodology is not optional knowledge. It is the foundation of every legitimate property tax challenge, and without it, you cannot even begin to evaluate whether your assessment is accurate. Now, here is where my engineering perspective becomes directly relevant to your financial situation. County assessors are responsible for valuing hundreds of thousands, sometimes millions of individual properties within their jurisdiction. The resources and time available to perform individual property inspections are severely limited in every county I have worked in across this country. As a result, the dominant assessment methodology used for residential properties is not individual appraisal. It is computer-assisted mass appraisal, abbreviated CAMA. CAMA systems generate assessed values by applying statistical regression models to property characteristic data, square footage, bedroom count, bathroom count, garage size, lot dimensions, construction quality classification, and effective age, combined with recent comparable sales data in the market area. The output is a mathematically derived value that represents what the assessor's model predicts your property is worth. It is not an appraisal. It is a statistical estimate, and like every statistical model, it contains error. The question is not whether your CAMA-generated assessment contains error. The question is how much error it contains and in which direction. The CAMA model fails most severely in 4 specific scenarios that are extremely common in the American residential housing stock. The first is property condition variance. CAMA models assign a construction quality and condition rating to your property based on assessor records that may not have been physically updated in years or even decades. If your property has deferred maintenance, functional obsolescence, or structural deficiencies, issues that a forensic engineer would document in precise technical detail, the CAMA model has no mechanism to capture that diminished value unless a physical inspection has been performed and the condition rating updated in the system. I have evaluated properties where the assessor's records showed a condition rating of good for a structure with foundation settlement, moisture-damaged framing, and outdated mechanical systems, a condition that would be rated fair or poor by any competent appraiser, representing a 15 to 25% reduction in market value that the homeowner was being taxed on as if it did not exist. The second failure scenario is incorrect property characteristics. Square footage errors are the single most common data error in county assessment records, and they are almost universally biased in the direction of overstatement. County records often include non-heated spaces, garages, unfinished basements, and covered porches in the living area square footage calculation. A 2,000 square foot home recorded in the assessor's database as 2,400 square feet of heated living area is being assessed on 400 square feet of phantom space that does not exist in the legal definition of heated and cooled living area. At a market value of $150 per square foot, that 400 square foot overstatement represents $60,000 of excess assessed value and potentially $1,200 or more in excess annual property taxes that you are paying on space that does not legally qualify as heated living area. The third failure scenario is exemption non-application, and this one genuinely makes me angry on behalf of every homeowner I have worked with. Every state in the United States offers property tax exemptions for qualifying homeowners, homestead exemptions, senior exemptions, disability exemptions, veteran exemptions, agricultural exemptions, and others. These exemptions can reduce your taxable assessed value by amounts ranging from a few $1,000s to over $100,000, depending on your state and your qualifying status. In most jurisdictions, these exemptions are not automatically applied. You must file an application, and research consistently shows that between 15 and 30% of homeowners who qualify for property tax exemptions are not receiving them, simply because they were never informed that they had to apply. The fourth failure scenario is uniform and equal violations, which is the legal principle that all properties within a taxing jurisdiction must be assessed at the same ratio of market value. If comparable properties in your neighborhood are being assessed at 60% of market value while your property is being assessed at 85% of market value, that disparity is a legal violation of the uniformity principle that forms the constitutional basis of property taxation, and it is grounds for an assessment challenge independent of whether your absolute value is accurate. Let me take you into a forensic property assessment case I was involved in as a structural expert witness in Cook County, Illinois in 2021, the second largest assessment jurisdiction in the United States, and one with a thoroughly documented history of assessment inequity. The client was a 67-year-old widow living in a 1968 construction single-family home in a south suburban Cook County municipality. Her annual property tax bill had increased from approximately $6,800 in 2018 to $9,400 in 2021, a 38% increase over 3 years, driven entirely by increases in her assessed value rather than mill rate changes. Her fixed income, Social Security, and a modest pension had not increased at a comparable rate. She was facing a genuine housing affordability crisis created entirely by assessment inflation. I was retained to perform a forensic structural and physical assessment of the property in support of her assessment appeal, and my investigation documented 3 separate quantifiable errors in the county's assessment records, each one independently justifying a reduction in her assessed value. Finding 1 was square footage overstatement. The county assessment records showed the property at 1,840 square feet of living area. My physical measurement of the heated and cooled living space excluding the attached garage, the unfinished basement utility area, and the enclosed but unheated rear porch, documented 1,560 square feet of actual heated living area. The county was assessing the property on 280 square feet of space that did not meet the legal definition of heated living area. Finding 2 was condition rating error. The county records assigned a condition rating of average plus to the structure. My forensic inspection documented a 22-year-old roof with granule loss and multiple shingle tab failures, original single-pane aluminum frame windows with failed weather stripping, a crawl space with inadequate vapor barrier and visible moisture staining on the floor joists, and an electrical panel with original 60-amp service capacity in a home requiring minimum 100-amp service under current NEC standards. The appropriate condition rating for the documented physical condition was fair, representing a meaningful reduction in assessed value that the CAMA system had never captured because nobody had physically inspected that property in years. Finding 3 was a missed senior exemption. The client had applied for and received the standard senior homestead exemption, but had never been informed of the Cook County Senior Freeze Exemption, a separate application that freezes the assessed value for qualifying senior homeowners at a base year level. The estimated cumulative exemption benefit she had foregone was approximately $4,200 in overpaid taxes across 2 tax years alone. The assessment appeal resulted in a corrected assessed value that reduced her annual property tax liability by approximately $2,300 per year. She had been overpaying by that amount every single year for multiple years, and she had absolutely no idea until a forensic review of her property records was performed. So here is what Engineer Vance needs every homeowner watching this video to do, starting this week. The first action is to obtain your complete property record card from your county assessor's office. This document contains every characteristic the CAMA system used to generate your assessed value. In most jurisdictions, it is available online at no cost. Review every single line item against your actual property. Square footage errors, room count errors, and condition rating errors are the most common and the most financially impactful discrepancies, and finding even one of them creates the basis for a legitimate appeal. The second action is to research comparable sales in your immediate neighborhood from around the assessor's valuation date, typically January 1st of the tax year. Identify 3 to 5 comparable properties that sold within 6 months of that date with similar size, age, and condition characteristics. If those comparable sales support a market value lower than your assessed value divided by the applicable assessment ratio, you have a legitimate equity argument for a reduction that is grounded in the assessor's own legal standard. The third action is to verify every exemption for which you may qualify. Contact your county assessor's office directly and ask what exemptions are available for your property type, your age, your disability status, your veteran status, and your income level. Ask whether each applicable exemption has been applied to your current assessment. The financial impact of missed exemptions is often larger than the impact of a successful value appeal, and the application process is straightforward once you know what to ask for. The fourth action, and this is the one most homeowners fail to take because they simply do not know the deadline exists, is to file your appeal before the deadline. Property tax appeal deadlines in most jurisdictions range from 30 to 90 days from the date the assessment notice is mailed. Miss that deadline by a single day, and your appeal rights for that tax year are extinguished in most states. Calendar the deadline the same day you receive the assessment notice. The appeal process itself is not complicated. Most informal appeals can be filed online or by mail with your comparable sales documentation and your corrected property characteristic data. And you do not need an attorney for an informal appeal in most jurisdictions. And if your property has documented physical deficiencies, invest in a structural engineering assessment that formally documents those conditions. At $500 to $1,500, that report is the most financially leveraged document you can commission, because on a property where a condition rating correction saves you $2,000 per year in property taxes, it pays for itself in the first 8 months. Property taxes are not a fixed and inevitable cost of homeownership. They are a calculated number produced by a system that contains errors, that relies on incomplete data, and that depends on homeowners not understanding their rights in order to collect more than is legally owed. Pull your property record card this week, check your exemptions today, calendar your appeal deadline before you close this video. And if your assessment does not reflect the actual physical reality of your property, challenge it with documentation and with confidence, because the law is on your side and the data almost always is too. I am Engineer Vance, Protect your structure. Protect your investment.